Welcome to Market Meridian, where we don't just chase daily headlines, we dig into the structural trends that will shape your wealth for the next decade. If you've been glued to the news lately, you've seen it all: US-Iran geopolitical friction, the Indian rupee's volatility, central banks dumping US treasuries and hoarding gold, endless debates about the future of the US dollar, and the rise of Bitcoin as a mainstream alternative asset. Most analysts will tell you these are random, disconnected events, just noise from politics and conflict. But today, we're here to prove that's wrong. What you're witnessing isn't chaos. It's a global monetary shift, a structural reset of the entire global financial system that's been building for years, accelerated by tension, but inevitable in its trajectory. This reset isn't about the dollar collapsing overnight. It's about more countries demanding options. It's about a move away from a single, dollar-dominated global monetary order toward a more fragmented, multipolar world. And for investors, this isn't just a macro story, it's the single biggest opportunity and risk you'll face over the next 5 years. Today's deep dive is 18 minutes of unfiltered macro analysis. We'll break down the catalyst behind this shift, why central banks are buying gold at record rates, why emerging market currencies are struggling, how Bitcoin is evolving from a speculative asset to a macro hedge, and exactly what this means for your stock portfolio. Buy. The end, you'll have a clear roadmap to position your wealth for this irreversible change. Let's start with the most visible trigger: geopolitical conflict involving major energy producers and global powers. Whenever tension rises, whether it's US-Iran relations, conflicts in the Middle East, or sanctions on oil-rich nations, governments start asking the same tough questions: how reliant are we on a single global currency? On cross-border payment systems that can be frozen or weaponized? On foreign-held assets that can be seized overnight? This is the acceleration of de-dollarization, not the cause of it. Make no mistake, the trend toward a less dollar-centric global financial system was already well underway long before recent tensions. For decades, the US dollar has been the world's reserve currency, the backbone of global trade, central bank reserves, and financial stability. But that dominance is eroding, and geopolitical friction is just speeding up the process. Why does this matter? Because every time a major power or energy producer faces sanctions or trade restrictions, it has an incentive to reduce its dollar exposure. For example, oil-exporting nations that can't easily trade in dollars start exploring alternative currencies or barter systems. Nations holding large dollar reserves grow nervous about the risk of those reserves being frozen or devalued. This isn't a new phenomenon. We saw it during the Iraq War, when Saddam Hussein switched oil sales from dollars to euros. But today, it's happening on a global scale, with more countries participating than ever before. Analysts have long dismissed de-dollarization as a fringe theory, a long-term dream with no real traction. But the data tells a vastly different story. Let's look at the numbers. Since 2020, central banks around the world have bought gold at the fastest pace in recorded history. In 2024 alone, global central bank gold purchases exceeded 1,000 tons, an all-time annual high. And China is leading the charge. According to data from the World Gold Council, China has added over 2,000 tons of gold to its reserves since 2022, while simultaneously reducing its holdings of US treasuries by more than $300 billion. This isn't a short-term trade. It's a long-term, strategic reallocation, a deliberate move away from dollar-denominated debt toward hard, neutral assets that no government can print, sanction, or weaponize. That brings us to the most critical question of all: why gold? What is the role of gold at moment? The ultimate no-liability insurance. Let's break it down in simple terms. Gold is no one's liability. Unlike the US dollar, which is a promise to pay, backed by the full faith and credit of the US government, gold is a physical asset that exists outside the traditional financial system. It can't be printed out of thin air like fiat currency. It can't be frozen in a bank account. It can't be sanctioned or weaponized by any government. Increasingly vulnerable to political risk, think of nations having their central bank reserves frozen, or being cut off from SWIFT, the global payment system. Gold is the ultimate form of insurance. It's a universal store of value that transcends borders, governments, and conflicts. Let's put this in context. During the 2022 Ukraine conflict, Russia was cut off from SWIFT and had hundreds of billions of dollars in foreign reserves frozen. In response, Russia turned to gold, using its gold reserves to stabilize its currency, fund trade, and maintain economic stability. For countries facing similar risks, gold isn't just an investment, it's a lifeline. This is why central banks are buying gold at record rates. It's not a speculative bet. It's a strategic hedge against the failure of the current dollar-dominated system. And this trend isn't going to reverse. As long as geopolitical tensions persist and the global monetary order becomes more fragmented, central banks will continue to prioritize gold as a safe, neutral asset. But gold isn't the only alternative asset gaining traction. At the same time we're seeing record gold buying, we're also watching emerging market currencies come under intense pressure, and that pressure is driving demand for another alternative, Bitcoin. Let's shift our focus to emerging markets, where the cracks in the current global monetary system are most visible. Take the Indian rupee, for example. Like many emerging market currencies, the rupee has faced sustained downward pressure over the past 2 years. As of March 2026, the rupee has lost more than 12% of its value against the US dollar since 2024. This isn't a random drop. It's the result of multiple, interconnected forces. A strong US dollar. As the Fed keeps interest rates higher for longer, the dollar remains attractive to global investors, leading to capital outflows from emerging markets. Rising energy costs. India is a net importer of oil, and higher crude prices push up its trade deficit, putting downward pressure on the rupee. Capital outflows. Investors pull money out of emerging markets in search of safer, high-yielding assets in the US global trade. Uncertainty, tensions over trade policies and supply chain disruptions make emerging markets more vulnerable to external shocks. Nations with high commodity import bills, India, Brazil, Turkey, Nigeria, are especially exposed. When their local currencies weaken, two things happen. First, citizens and businesses face higher costs for imported goods, from fuel to food to electronics. This erodes purchasing power and fuels inflation. Second, governments and central banks face pressure to stabilize their currencies. But with limited tools, they can't print dollars, and raising interest rates too high can crash their economies. They turn to alternative stores of value. That demand for stability flows into two places: traditional safe havens like gold, and decentralized alternatives like Bitcoin. For years, Bitcoin has been dismissed as a speculative asset, a digital casino with no real value. But that narrative is shifting, and rapidly. From a macro perspective, Bitcoin is increasingly being viewed as a digital alternative to gold, a scarce, borderless, censorship-resistant store of value. Let's define what makes Bitcoin unique in this context. First, it's scarce. There will only ever be 21 million Bitcoins in existence, no more, no less. Like gold, it can't be printed or inflated out of existence. Second, it's borderless. You can send Bitcoin anywhere in the world, without relying on banks or payment processors. Third, it's censorship-resistant. No government or institution can freeze your Bitcoin holdings or block your transactions. In a world where the global financial system is becoming more fragmented, assets that exist outside traditional banking and political systems gain strategic importance. This is why institutional investors, from hedge funds to asset managers, are increasingly adding Bitcoin to their portfolios. It's not just a crypto play anymore. It's a macro hedge. Alongside gold, the data supports this shift. In 2024, the correlation between Bitcoin and gold rose to 0.78, up from just 0.22 in 2022, according to data from Bloomberg. A correlation of 0.78 means the two assets move in the same direction most of the time, a clear sign that Bitcoin is being integrated into the global macro landscape. And it's not just institutions. Retail investors are also waking up to Bitcoin's potential as a hedge against de-dollarization and currency volatility. In India, for example, Bitcoin trading volumes have surged over the past year as the rupee weakens. In Brazil, Bitcoin adoption has grown by more than 40% since 2024, as citizens look for alternatives to a volatile local currency. Make no mistake, Bitcoin still carries risks. It's a volatile asset, and its price can swing dramatically in short periods. But from a structural perspective, its role in the global financial system is evolving. It's no longer just a speculative asset. It's a digital store of value that's here to stay now. Let's connect all these dots back to the stock market, the place where most investors park their wealth. Because the global monetary reset doesn't just impact gold and Bitcoin. It changes the rules of the stock market entirely. A global monetary reset does not mean stocks will crash automatically. But it does mean the rules of the game are changing. The stock market is entering a new regime, one where the companies and sectors that thrived in the dollar-dominated, globally interconnected era may face significant headwinds, and a new set of sectors will emerge as long-term leaders. Let's break down the winners and losers first. The headwinds: companies that rely on a dollar-dominated global supply chain, cross-border payment systems, and dollar liquidity are at risk. This includes many large-cap tech firms that generate a significant portion of their revenue overseas, multinational consumer goods companies, and financial institutions that are heavily exposed to emerging market risk. In a more fragmented, multipolar world, these companies may struggle with currency volatility, trade restrictions, and reduced access to global capital. Second, the winners: sectors tied to real assets, energy security, commodity independence, precious metals, and digital scarcity are likely to gain long-term relevance. Let's list them out. Precious metals and miners: gold, silver, and other precious metal miners will benefit from sustained demand from central banks and investors hedging against de-dollarization. Energy security and commodity independence: companies that produce oil, natural gas, and critical minerals, lithium, copper, rare earth metals, will gain strategic importance as nations seek to reduce their reliance on foreign energy and commodity supplies. Real assets and utilities: infrastructure, renewable energy, and utility companies that provide essential services and have tangible assets will be more resilient in a volatile monetary environment. Digital scarcity: Bitcoin miners, blockchain infrastructure firms, and companies building decentralized financial (DeFi) systems will benefit from the growing demand for alternative financial systems. This is a stark contrast to the past decade, where growth stocks, especially unprofitable tech firms, led the market. In the new monetary regime, value and tangibility will matter more than growth at all costs. Companies that generate consistent cash flow, have strong balance sheets, and are tied to real assets will outperform those that rely on speculative growth and dollar liquidity. The biggest mistake investors can make right now is focusing only on daily price action. They'll miss the structural shift unfolding beneath the surface. The biggest opportunities and risks over the next 5 years won't come from quarterly earnings reports or short-term Fed decisions. They'll come from this global monetary reset, from the companies that position themselves to thrive in a multipolar world, and the sectors that are being left behind. Key takeaways: your roadmap for the reset. Let's summarize the key takeaways from today's deep dive. 5 critical lessons that will shape your investment strategy in the years ahead. First, geopolitical conflict is accelerating de-dollarization, not causing it. The trend toward a less dollar-centric global financial system was already in place. Tension has simply speeded it up. Don't mistake the catalyst for the root cause. Second, central bank gold buying is not a fad. It's a long-term vote of no confidence in relying solely on the dollar-based global monetary system. Gold will remain a core hedge against currency risk and geopolitical uncertainty for years to come. Third, emerging market currency volatility exposes the fragility of the current system. This volatility will drive sustained demand for alternative stores of value, both gold and Bitcoin, for the foreseeable future. Fourth, Bitcoin is evolving from a speculative asset to a macro hedge, alongside gold. As the global financial system becomes more fragmented, digital scarcity will become increasingly valuable. Expect Bitcoin to play a larger role in institutional and retail portfolios alike. Fifth, the stock market is entering a new regime. Investors must position for a more fragmented, multipolar financial world. Prioritize real assets, energy security, precious metals, and digital scarcity over speculative growth stocks tied to the old dollar order. The noise from politics and conflict will come and go. Headlines will shift, tensions will ebb and flow, and short-term market trends will dominate the news cycle. But the reset of the global monetary system is irreversible. It's a slow-motion revolution that will unfold over the next decade, but its impact will be felt in every corner of the global economy. If you want to protect and grow your wealth in the years ahead, you cannot ignore this shift. You need to look beyond the daily headlines, understand the structural trends at play, and position your portfolio to align with them. Thank you for joining me today for this deep dive into the global monetary reset. If you found this analysis valuable, hit the like button. It helps more investors find this critical information. For more macroeconomic insights, geopolitical analysis, and strategic investment perspectives tailored to this new monetary regime, subscribe to Market Meridian and hit the notification bell. We release new videos every week, cutting through the noise to focus on the trends that matter most to your wealth. Remember, in a world of constant change, the only way to stay ahead is to understand the system. We'll be here